Hello everybody, today is March 19th and this is our intraday trading using the Wyckoff Method workshop. We're going to spend the whole day together. It's 8:30 on the Pacific Coast in the US and we're going to be done by 4:30 p.m. Pacific time. We're going to have 4 sessions and with breaks in the middle, and we're going to have a 45-minute break. One of the things that I want to talk while people are still arriving is what we're going to do today, how it's going to happen, and what you can expect. So as I mentioned, 4 sessions, and one of the things that I'm going to do today is I am recording all of the sessions, but part of the introduction part is not going to be recorded, and that's all related to the release forums. So my intent today is to talk directly to people who sent me the release form, and then to talk indirectly with people who didn't. So all of you will be able to ask any questions or to give me any comments, as you usually guys do through the questions box. So just type it in if you feel like you don't want your voice to appear on the recording, and I will address this question. All of the recordings are going to be available after probably a week. We would have to upload them. We would have to create the course there on the learning management system. So it might take a while. It might take until maybe like Friday, Sunday, depending how quickly we're going to go. But all of the recordings are going to be available. I already have sent you the slides. Now with the slides, I already know that you guys went through those slides. Okay, so there is nothing bad in that. It was intentional for me to send you those slides, and the reason why I want you to have those is because I want you to make notes on those slides. But there are some solutions to a couple of exercises that we're going to have here. So you're going to do yourself a misfortune if you going through the solutions. So please do not go through all of the slides. Plus, I already sensed in some of the comments, that I've received about the slides that, you guys might have some questions about some slides and so on and so forth. Okay, again, running too fast, right? So get your minds in the now. Let's be present. With where we are right now. We are on slide number 2 right now. So this is where we are, and I don't want you to think or look forward, because you basically are going to lose, any thoughts or any concept that we're going to be talking about on a particular slide. Plus, the slides are on the, kind of like a guide for us. There's going to be a lot of discussions that, I can't just put on the slide all of the thoughts and discussions that we're going to have. So, and that's usually how it happens, with the workshop. I send out the slides, and then everybody just looks at them, and, so it's not like something new. Okay, so lunch from 12:30 to 1:15. Please make sure that you return on time. There's going to be evaluation forms that we're going to send probably tomorrow. Let's not overwhelm ourselves today, but tomorrow when you have a chance, just fill out those evaluation forms. They're very helpful to me and my staff, and the reason why is because we really listen to your feedback. So the workshops that we've conducted, the previous ones, we've collected the evaluation forms, and they were extremely helpful. We make adjustments for the workshop. Now this workshop, the content of this workshop is new. This is the first time we're conducting the Intraday workshop. So we definitely want to receive some kind of feedback from you. Okay, typical disclaimer for all of the sessions that I conduct. This session is only for educational purposes. Okay, and we're gonna go through the introduction, and this is where I'm gonna stop recording. So I will not record right now. I repeat, I will not record right now. What I would like to do is I would like to go through all of the people that we have here and introduce themselves very quickly. Again, I'm not going to record anything, so this is not going to be a part of the recording. And this exercise is extremely important to me. It sets the tone for the whole day. It also gives us an idea of who we are as a group, who we are as traders, what people are doing, what are the questions, what is the intention for this workshop. And I'm going to start with myself first, and then we're going to come to everyone else. And I'm going to stop recording right now, and then I'm going to start after we're done with this process. All right, we are back. Okay, I'm going to put Wes as well. All right, great. We are back, and we are continuing with our workshop. We just did the introduction session, and there is such a good group of people, and there are a lot of commonality on the intention, which I was really happy to hear. And there are a lot of things that we're going to address from, the issues or the problems that you guys raised during the introduction section. Okay, so let's quickly go through the workshop outline. I'm not going to spend a lot of time here. We've done the introduction. We're going to quickly review the method. So this is going to be probably the quickest review that I'm going to do. And we'll talk specifically about the structural concepts because those are going to be crucial for us to understand the rest of the slides. There are maybe like 3 or 4 people who I'm not sure what the level is of understanding of the Wyckoff methodology, so we have to be on the same page. We have to talk the same semantics. And in a lot of cases, because the volume signature on the intraday is so kind of like related to the specific sessions, we're going to be relying more on the structural analysis rather than on the volume analysis. But we'll talk at the end, in the Q&As, about the intraday volume. So this was one of the questions that was asked. Under the review, we'll talk quickly about the change of character, phase analysis, Wyckoff events in the ranges, in the trading ranges, and the swing reversal concept. So those concepts, those 1, 2, 3, 4 concepts are going to be crucial for us to understand what we're talking later on during the workshop. Our first case study is going to be on the currency. We're going to look at the euro dollar, and we're going to look into how can we synchronize different structures in different time frames, and what kind of advantage can we gain at the intraday level if we're understanding a much larger trend. And obviously we're going to zoom in to the point of entries there, and we're going to talk about, how could we possibly enter on the intraday level, and some specificity going to be there related to the currency trading, to forex. So for those of you who are trading forex currently, that's going to be an interesting discussion. Then we're going to switch to stocks, and our first case study on the stocks is just going to be all about momentum stocks. We'll talk about why do we want to pick the momentum stock, how do we identify the swing bias there, how do we identify the structure there, and how can we enter the stocks on the confirmation of the return on leadership. We'll talk about general guidelines and rules for day trading the momentum stocks. And there are quite a lot of opportunities there because we have a lot of stocks there that are momentum stocks. But in particular, we're going to concentrate on FAN stocks, Facebook, Amazon, Netflix, Google. And I'll talk about, why it's crucial for us to understand what are the popular momentum stocks are. We'll talk about how a chase for a number of stocks with the specific characteristics could be a little bit misdirecting and distracting, and could create some kind of emotional regret if we miss an opportunity on other stocks that actually have the momentum that day. So we'll touch upon that. Then we'll talk about if we are following, let's say, 4 or 5 stocks, how do we actually choose a specific stock on a specific day, and this is the question that Karen was asking, and her question was more related to the futures and currencies, but it's going to be the same logic, so we're going to apply the same logic, and I'll bring up the chart, of the currencies, and, we could probably just even look at that. Okay, then we'll go into that idea of the switch from the intraday entry to the swing trade. So for those of you who have mentioned, and there were maybe 3 or 5 mentions of that, I'm a swing trader, but I want to be more efficient on the entry. So, and the way to get efficient on the entry is through the intraday entry. So therefore, that segment is going to be extremely interesting, and for those of you who are swing traders. So we'll talk about that. We'll reconfirm that with the case studies on monster beverages, and then we'll talk about the rest of the session. We'll talk about the E-minis. So E-minis is a very popular tool for us to day trade. It has a lot of liquidity. There's a lot of analysis that you can find, on the net about that. So first, I'll talk about the rules and guidelines that I use in my trading of E-minis, and then we'll go into 2 case studies. We'll talk about the difference between the daily swing bias, and we'll talk about the intraday structural bias as well. So, and it's going to be interesting because with the daily swing bias, you're basically given one directional trade more weight than another. So for instance, if the daily swing bias is up, then obviously all of my intraday trades are going to be in the direction of that trend. But there are some instances where that's not going to be the case. There are some instances where you're still going to have a daily swing bias which is up, but your intraday price structural analysis is showing that you should be able to have the full size position in both directions. So we'll talk about that distinction. And then we'll talk about, again, that idea of a switch from the intraday to the daily, and how to implement that on the with the E-minis. And then the last session is going to be on the Q&A. If we are going to finish closer to 4:30, I don't mind staying like extra half an hour, to answer the Q&As. I'll, try to pace myself with the material, but I also, me guys, whenever I feel that the concept is important, we'll stop, we'll slow down, and we'll, talk it through, we'll discuss it more, because some concepts, require more attention from us than other concepts. So, I'll kind of like try to manage that. And at any point, if you have a question, type it in, or for those of you who gave me their release forms, just say that you have a question, I'll unmute you. All right, so the first thing that we're gonna do is we're gonna review the method, and we'll do it really quickly. Now, for those of you who have not attended the advanced Wyckoff course sessions and you feel like you have a question, it's important that you stop me and ask that question, because then later on throughout the whole day, if we go through, it's going to be difficult to come back and to kind of like revisit that. So let's make sure that if we have a question right now, let's address this. And for those of you who have taken that class, those classes, and you have a question or you want to clarify something, again, stop me. There is no reason not to repeat some of the things. All right, let me just take a breather here. All right. So the first concept that we'll talk about is the change of character. Now, why this is such an important concept? So I started introducing this concept, kind of like a year ago, and I started putting more and more emphasis to this idea. So Wyckoff talks about the change of character, but he primarily talks about it, throughout closer to the end of the trading range, where we start having those changes, and the price starts behaving differently, the volume starts behaving differently, maybe a comparative signature also starts behaving differently. But I think that we should really approach it more systematically. I think that there is more to this idea than just, that change of character on the way out. Initially, the change of character is going to occur after an established trend during the stop in action. And the first action in the opposite direction is going to be your change of character. So for us, when we look at the Wyckoff structure and we're looking at primarily at the trading ranges, phase A, which is the first phase after the trend in action, is going to show that something different is happening than what has been happening in a trend. And specifically for accumulation after the downtrend, we're looking for some type of rally that's going to behave differently than all of the rallies that we've had in the downswing before. And that's just going to tell us that big institutions are finally coming in and at least temporarily stop the price from continuing from going down and therefore that intention by big institutions is going to produce absorption of the supply. The big institutions are going to provide demand at that point, and therefore not only they're going to provide absorption of the supply, the extra demand is going to push the price up. Also, strong professional hands are going to be closing their positions that they've opened somewhere, before the downtrend started or during the downtrend, and therefore their closure of their positions also going to produce that momentum to the upside. And therefore, that's the first time when we're going to have that change of character. Now, a change of character is not necessarily just one rally. We also want to see what kind of reaction we're going to have, on the way down. Are we going to have a continuous action to the downside? And usually if the true climactic action has occurred, the next retest, is not going to produce a big wave to the downside. The secondary test, the local test of the climactic action, should be somewhat in the proximity of the climactic action. So it could be a high or low. It could come to the support level that was created by the climactic action, or it could create a low, which is totally fine, and it just shows ability of the supply to move the price below the support. So for the change of character, we always would like to see both, you know, the counter action to the previous trend, and then attempt to continue that trend and failure to continue in the same manner as the previous trend. So, and the change of character for us at this spot is going to be significant, because basically it's just going to tell us that we're going to consolidate for some time. From trending environment, we are going to go into non-trending environment. And that's very significant analytically and from the perspective of trading tactics, because analytically now you're expecting that you're going to use different tools to analyze this environment, this new environment. You're going to probably use non-trending tools. From the tactical point of view, first of all, you have to think about your exit criteria here in this area for the trade that you've had here. And I think that we've had the discussion, you know, at this last market outlook. I'm trying not to name the names, to go with the names here, but you know, we had a trader who was showing us a great entry for the short trade. You know, he was shortened a stock, and yet the exit was not necessarily at the most optimal place. And I think that one of the mistakes there was, you know, inability to identify that a change of character when it has happened. So therefore, change of character is just a very significant tool for exit techniques. And then as we go through the consolidation and we do our phase analysis, which I'll touch upon in the next slide, we want to see a change of character that is going to be a change of character from non-trending environment back to a trending environment. Change of character can help us out also with the directional bias a little bit, but primarily, you know, like in stocks, we would be looking, and especially at the high time frames rather than intraday, we would be looking at volume signatures, supply and demand signatures. We would be also maybe, you know, having a quick look at the comparative advantage, comparison, just to see whether the leadership is coming back and so on and so forth. And here, change of character might be more evident because we are expecting for accumulation the largest rally and the smallest reaction. So a change of character could be much more evident. We also talked about a change of character bar. So this is the concept that I've been introducing in the last 3 cycles or so. And change of character bar is really crucial because it can occur really early on the change of character rally after the downtrend, and this could be your point of exit. So this point of exit, and I'm kind of like speeding here with all of these concepts, but for those of you who have taken my classes, you guys kind of you know, should be following me here. Why this is an important concept? Because of the, again, effectiveness of your exit. If you're exiting right here, even though it's not the low and you're not waiting for the secondary test, depending on the time frame that you're using, you're basically mitigating your risk a little bit here, because the price might always do that. And you might be kind of like far away, you know, from getting the price, the better price. And then the second reason is it actually might take some time, you know, to go to the secondary test. So you're basically wasting time and you're still staying in this position, whereas, if you would have exited here, you might be already, onto something else. So it's the effectiveness, effective use of capital that's under the question with these concepts here. Okay, and the same we're going to observe on distribution. So the trend is going to have a change of character first, which is going to tell us that we are potentially going into the consolidation or potential reversal, and then on the way out we're going to have the same attributes to the change of character as we had in accumulation, only reversed. We want to see the largest reaction followed by the smallest rally to the upside. Okay, great. A quick question from a quick question or a quick comment. Will we cover redistribution and reaccumulation? So this workshop was not intended, to cover this material, and we're going to cover that in the advanced Wyckoff course. So for us, you're going to have that opportunity. We'll talk about structural analysis a lot during the first month in April. So, this is where we're going to discuss it. Okay, so let's talk about phases. What's behind phase analysis? Why is that important? So imagine that we are in the downtrend right here, and then we are observing a change of character. And I think that I put enough emphasis on why change of character is so important to us. Change of character, again, is going to define the area where a lot of trading decisions are going to be made, and also some of the analytical tools, approaches are going to become different for us. So once we experience the change of character, we are expecting a consolidation. As consolidation develops, we want to understand that different periods in the consolidation are going to have different intentions behind them. So for instance, I mentioned that phase A intention is all about stopping of the trend. Whether the trend was down or up, we want to stop that trend. How do we stop that trend? If we had a downtrend, then demand needs to temporarily absorb supply and push the price up in the manner that was different than anything that we've seen before. Then as we are locally testing the climactic action and we define the change of character by the automatic rally, we're going into phase B, which is basically the phase that is the phase that we're going to call building the cause, or sometimes I call this a war between supply and demand. We want this phase to be the larger phase than phase C and phase A. Usually when you label, and this is one of the common mistakes that I see in labeling, and that is that phase B is, on some of students' labeling is smaller than phase C or phase A. And usually that's not the case, and that's a good guideline to have. In some of the instances, phase B is going to be small, or kind of like the same as phase A and phase C, and primarily that happens with hypodermic action during the distribution pattern. But today we're not going to concentrate on that. Again, if you feel like you need to study that more, just come back to advanced Wyckoff course material. There we go into the details of, of all of those particular patterns, particular structures. Phase C and phase D are the two crucial phases that we want to identify as much as possible. Phase C low is going to be the lowest point for the trend that's going to follow. So therefore, this is the place where we start thinking about opening a position. Phase C and phase D are going to have the elements of the change of character. In the accumulation, we're going to have a much more pronounced rally to the upside, and the following reaction is going to be much less than the reaction that we've seen before in the trading range. So therefore, this type of change tells us about this change tells us that the price is ready to leave the trading range. The price is ready to move in the direction of the next trend. And of course, you know, structurally, we're going to have different events taking place during this time. So we'll discuss that in the next slide. Okay, so let's think about, you know, and let's talk about different events in the accumulation range, and then we'll talk about the distribution. So we went through the phases, we went through the changes of character, but what are those Wyckoff events? So during specific phase, Wyckoff would define specific events that would be kind of like a signature for that particular phase. So for instance, in the stop in action phase A, we want to have a stop in action which is going to be identified by the climactic action, by the sell-in climax. And sell-in climax, as any other Wyckoff events in the range, is going to have specific attributes, price attributes and volume attributes. So for instance, for the climactic action, we want to see an acceleration of the price to the downside, where we would see, you know, largest spread, maybe gaps to the downside, and we want to see the volume signature, you know, to look like a climactic signature with the increase of volume to the downside. So that would tell us that supply is increasing. The weak professional and weak public hands are dumping this particular stock, let's say, and the big institutions are coming in and from the opposite side increasing the volume signature because they are buying, they are providing demand, and therefore volume signature is going to go up. Secondary test, as a test, a local test of the climactic action, our preference would be that supply would contract, decrease on this rally to the downside. We would judge by where the price actually stops on the secondary test as to the strength, potential strength of you know, this test in action and potential strength of the supply, which is, you know, still present. We would prefer, and we always look in actually, you know, to see the secondary test in phase B, that test in action. And in terms of the test, in general, guys, you know, one of the easiest things to remember about the tests in the structure is first test, second test, third test. And these tests, they happen in each phase, right? So first test, secondary test of the climactic action, second test, secondary test in phase B, third test, phase C, as a whole phase. And what do we test? We test the previous lows. So we always test that supply. Is supply still available? And if it's still available, is it a big supply or not? Okay, so what else is here? Well, we obviously want to talk about Wyckoff points here at phase C, because this is one of the most important important points and important phases before the trend starts. So the phase C is going to have for us two scenarios. We're either making a higher low in phase C or we're making a low low. The higher low is going to be labeled as a last point of support, and the lower low could be labeled as a spring, and you could see this on this slide, or a shakeout. Both spring and shakeout would require testing action, which we'll have as a higher low, and preferably on the contracting supply. And then after that, we're going into phase D, where we're going to have a sign of strength rally, and that rally might contain some significant sign of strength bars. And we might have, after that, after the sign of strength rally, we might have the backing up action, which is a smaller reaction, the smallest reaction in the trading range. There might be some variations on that, but you know, again, this is not the class to discuss all of those small nuances. I'm just going, you know, with the general overall kind of like review of this material. All right, guys, I'm gonna stop for 2 minutes. I just need to grab a drink. So use this time to grab a drink, a tea, a coffee if you'd like. And then when I come back, I'm just gonna continue. I just need to do this really quickly. Okay, hold on a second. All right, I'm back. Distribution. So we are going to have the same phases, and the intention behind the phases is the same. Phase A, stopping action. What are we stopping? The previous uptrend. How do we recognize that stopping action? By several points. One of them is going to be climactic action, and here again there are quite a few nuances on the climactic action after the uptrend. One of them is that in stocks, especially in the mature stocks, you might not recognize the climactic action at the time when it happens. And the reason why is because mature stocks are not going to necessarily produce you a big spread to the upside, acceleration of the price to the upside. They might have some gap in action, but it's going to be a little bit difficult to identify a climactic action. Sometimes it's extremely evident and sometimes it's just hidden. So another way to identify climactic action is actually after the fact on the change of character of the automatic reaction. So change of character happens, and we are assuming that we're going to go into the non-trending environment after the trending environment. And therefore, as we assume that non-trending environment has started, we're doing our phase analysis. In phase B, during the distribution, we would be looking for the signs of weaknesses, minor sign of weaknesses. In phase B, upthrust actions that are where the price commits to the upside temporarily and then goes down almost instantly back into the trading range. The last upthrust action as a higher low is going to be in phase C. And again, phase C intention is all about testing of the previous highs, and testing how demand is capable of moving the price to the upside, and testing the availability of the supply at the resistance points. And then going into phase D, we are producing our change of character where the price travels, commits below the support, and usually this is going to be the largest reaction to the downside. It might have a much better supply signature. It might have increase of the spread to the downside, and so on and so forth. And then a last point of supply rally that's going to fail is going to be the smallest rally in the whole trading range. And usually the narrative here behind these actions is that during phase C and D, composite operator big institutions already do not care, they do not care about hiding their footsteps. They are aggressively selling because they see something on the horizon that is not good for that particular stock or the instrument, and therefore their distribution is going to be more visible. And it's going to be more visible, from the commitment of the price below the support, or from the spread that we're going to see on the sign of weakness reaction. All right, and the last concept for us to discuss, and I think we're good, we're really doing well with the time here, is the definition of the swing. So this is somewhere where I want to stop a little bit and see if we have any questions, because for those of you who have taken advanced Wyckoff course completely, and especially the 4th month, you are familiar with this concept. For those of you who have not taken the 4th month of the advanced Wyckoff course, or you haven't taken the advanced Wyckoff course at all, this is going to be new, because this is not in the methodology. This is something proprietary that I've developed for myself, for my own trading. But it's really crucial for us to understand the swing analysis. How do we identify the swings? Usually people would say, okay, well, I would take the high and I would take the low, and that would be my swing. But it's not as easy as this, So for instance, how do I know that, let's say at this point right here, that the swing has not reversed? So the key concept here is a swing reversal. At which point, at which particular bar do we actually know that the current swing is done and that we are potentially in another swing? So let's look at how we would handle this. I'm identifying what I call a significant bar. Significant bar usually are going to have big spread. It's going to have the close that is going to show the commitment to a trend. So therefore, if we have a significant bar to the downside, we want to see the close below 1/2 of the spread. So big spread and good close. And then we also want to see that commitment, the close, which is going to be above, so let's say this bar right here, this close is going to be above the previous commitment line that was created by the short-term resistance. So in this case, the previous bar has this tail to the upside. This was the highest level where the price could travel at that point. So we want to move the price to the upside in the manner that's going to commit above this line right here and close and hold there. So therefore, every time you have a significant bar, this is what you would like to do. So let's just go through this, and it's going to be more self-explanatory. I see that the last significant bar right here is to the upside, so I'm assuming that there was an upswing at this point. So my commitment for the reversal to the downside is all going to be about this level right here, this low. So I'm looking for a bar that's going to commit below this level. And here is this bar, and it is a significant bar, which is really great. The true range of this bar actually has started at the previous close right here. And we see that the body of this bar is big, the close is below the 1/2 spread, and we see that the reversal has happened, and now we can say that we are in the downswing. As the price goes down, it creates new commitment levels, and my commitment level to the upside, if I want to reverse, is all going to be about this bar right here. This was the last significant bar to the downside. So therefore, this is the bar that needs to be reversed. So I'm placing the commitment bar, the reversal bar for the upside at the high of the true range of this bar, and I'm just basically waiting for the price to reverse this level. There is an attempt to reverse it, a big bar to the upside, but it's not coming to this level. So therefore, there was no reversal, at least on this time frame. The next bar commits to the downside. It's a big significant bar. So every time we have the new commitment, now let's say in this case to the downside, we're going to move the stop loss. So if this was our commitment to the upside and the stop loss level, this is the next level where we're going to move our commitment. Next bar, so let's say it's this one, and therefore our stop loss is going to be moved. Next commitment, and I apologize, I don't know why this moved a little bit, so it's covering some of the bars. So we're going to move the stop loss here. Next one, going to move the stop loss here. Next one, going to move the stop loss here. And then suddenly this bar reverses the last bar to the downside. So at this point, we are saying that the downswing is done. It has been reversed, and there was a reversal to the upside. And then we're just basically doing the same thing to the upside. We are looking for the significant bars, moving the stop loss. So the original stop loss was here, 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 here. Well, this one we really shouldn't. Here, and then with the big bars, what you can do is just to put it slightly below 1/2. Here, here, and here is our reversal. So look at this chart. I mean, this is price line on the weekly. This is the chart that I'm using in the advanced Wyckoff course. I mean, if you would recognize on the weekly this reversal right here, and you would stay through the whole swing, you would travel in the straight from about $75 to about the close here on this bar was maybe about 210 or somewhat. So you are making a really good return here just on this concept alone. Now the question, does it work in all time frame? And that's the beauty of it, that it does. Now it's a trend following technique. So one of the disadvantages of that, and this is what I hear from students, is that it's not going to get you out at the top and it's not going to get you in at the bottom. But if you have a significant trend, you can catch a really good percentage of that trend. So you're going to catch probably from 60 to 80% of the trend. And that's what we want to do when we are trend following, when we are trending. We want to catch the majority of the trend, and our goal is not to actually, pick the top and the bottom. And this concept is going to be also very crucial, because when we go into the trading range and we see, let's say, a change of character bar, this bar most likely is going to be a reversal bar. And this reversal is going to be based on this concept. So we want to recognize the reversal of the swing as early as possible. Then think about what happens next. Automatic rally. And if we are day traders, and this is a daily chart, and we are recognizing that there is some kind of structure right here, and then on the daily there is some kind of reversal, our positions are going to be initiated here with an idea that the price is going to go lower to the next structural point, which is a secondary test. So therefore, swing reversal is extremely important, especially if you have multiple sessions on the way down. You need to define the swing bias and basically open all of the positions in the direction of that swing bias and in the direction of the structural context. And I want to kind of stop here because this is a really important point. So let's see if we have any questions. And let me just repeat this. Why do we need to understand the swing structure? For the intraday trader, you need to understand the daily swing structure because it's going to give you a directional bias. You need to understand the structural analysis of where you are in the higher time frame structure, because that's going to give you an indication of the next potential action within the trading range or within a trend. And therefore, it's also going to give you a directional bias. And yeah, so those are very, very important concepts right here. And one of the things, I think was the beginners in day trading is that there is no definitions like that. So therefore, at the beginning when we start day trading, we usually open up, like 5 minutes, maybe like 30 minutes, depending on the market. And we are trying to recognize, some patterns right there. But we don't really think about the magnitude or the strength of the patterns on the higher time frame. And therefore, sometimes what seems to be a very strong intraday pattern in one direction could be negated really quickly by a much larger trend on a higher time frame. So for those of you who are listening to me right now and you guys are thinking, well, I know this, I kind of know this. But if you don't do this, if you don't look at that, then knowing is not really benefiting you, in terms of, consistency of profits. And usually it's those type of basic, concepts that are going to bring you a lot of profits. If you think that you know but you don't do, then you're going to fail more times than the person who actually thinks very consciously about those things. Okay, so and we'll talk a lot about this today. I kind of want to put this in your minds, and to be extremely articulate about this couple of concepts here. Okay, so what are the boxes here on this chart? Okay, so we have This box is the significant bar box to the upside. Reversal bars in blue, so I'm identifying specific reversal bars that defining the swings. And then the green boxes here are significant bars to the downside. So yellow significant bars to the upside, green to the downside, blue reversal. All right. Yeah, and guys, it's great that you're asking questions, and I understand that the majority of you kind of already know this material, so that's fine. All right. Any questions on the reviews that we went through? All of the structural concepts that we need to go before we go forward. Any other questions, especially from those of you who have not attended Advanced Wyckoff course before? No questions. Okay, great. All right, let's see. So we have around 15 minutes before the next break. Okay, so let's go through the first case study, and we'll see whether this is going to be whether we'll have to come back to this or whether we'll be done like in the next 15-20 minutes. So this is our first case study, and during the case study I'm gonna throw an idea to you. So like right here I put that this is idea number one. Idea number one, day trade when the long-term structure, daily swing structure, and intraday structure are all in sync. Sounds like a very easy idea, to think of and to implement, but unfortunately, because of this easiness, there is such a disregard to this idea. So, and it's a very basic idea, but I want us to explore this in this case study and kind of like give it a lot of credit. So the instrument that we're going to look at is going to be Euro, US dollar, and the time frames that we're going to go through during this case study is going to be, we're going to start with the very long-term structure, monthly structure, and then we're going to come down to the daily structure, and we're going to look at the swings there, and then we're going to go to 240 as a structure for our points of entry. And actually, I think that I went one time frame below 240. Yes, I think it was maybe like 30 minutes, so, and I didn't put it here. All right, so let's look first the monthly structure. So this is a very long-term chart. And obviously, as a day trader, you're not going to be looking at this chart like every day. But whenever you start trading an instrument, you really have to think about analysis first and then trading. How do you start your analysis? You start with the long-term time frame. So for instance, a monthly, you want to understand the whole history of the instrument and then understand the more current history of where we are structurally. So we look at the history of Euro and we see that there has been a big uptrend, and we're looking into this area when we're seeing a change of character, and this change of character has big down bars, the largest reaction to the downside, the fastest reaction to the downside. Almost all of the profits on the last downswing were negated. So this type of quick move to the downside has a specific narrative from big institutions as to what they're doing in this area. And it shows a lot of urgency to sell this instrument by big institutions. We definitely see this as a change of character, and therefore we are expecting a consolidation from this point on. Now, imagine how huge this consolidation is, right? So 1.6, 1.2, So we definitely have a lot of pips to collect here in between these two boundaries. So therefore, it's a prime opportunity for us to day trade this structure with an understanding of what should happen next, right? So for instance, as we're experiencing this reaction and let's say we didn't catch anything, what do we expect next after the automatic reaction? We just went through the review of this phase analysis and structural analysis. We would expect a secondary test that's going to try to come to the climactic action resistance here in order to retest it. And we know that it also can fail, it can overshoot the resistance. So therefore, in this area right here, we would be concentrating on any of the trades that are going to be to the upside. Once we see some kind of failure, and this is the trade that Tom likes, so once we see that failure, we could take advantage of this because we know that there's going to be, this retest. So our day trading bias is going to be to the downside, and obviously this is monthly, but we can talk about the swing trades here and so on and so forth. And so on and so forth. So during this trading range, we could use our knowledge of the structural analysis to identify a directional bias for swing trades and for intraday trades. And obviously, as we go to a lower time frame, like daily, we're going to be creating different directional biases there. But big biases are all going to be created just because of this structure. So if you go to the intraday, let's say that you're going to the intraday action somewhere here, it's going to be really futile if you're just looking at the intraday. You really have to understand a much larger contextual structure where we are in order for you to be more confident about the direction that you're trading or the direction of the signals that you're looking for. All right, so let's go through this structure. Last lower high before moving to the downside was phase C, and please look at how, again, this power of 3 tests is playing out here. First test, second test, third test. And usually in the large structures, we're going to see a lot of that, like tests in each phase, and the last test is going to be your phase C. Even if you're wrong about phase C being there and it's still phase B, you have to think in terms of the scenarios. If this is a lower high in phase B, then what should happen next? The price should retest the previous support, so at least we're going to go here. On a larger time frame like this is a huge move, right? So for the intraday trader, all this, pips that could be collected here, and this is about 2,000 pips here, it's a huge gain. So therefore, even if we could be wrong in identifying a specific phase, but we could be extremely right in terms of how we're trading that swing. So some words specifically about the structure. So this is a different structure than we've seen, on the previous schematics. I talked about the urgency here on the change of character. This is a TP formation. And in the TP formation, again, we're going to have the lower lows going into phase B, and that's because supply is being provided right away by big institutions, and we have a lot of signs of weaknesses here in phase B, and we see that sign of weakness here in phase B. And that's because institutions are selling right away. They're not waiting for the trading range to develop to sell. They want to get rid of the position right away. And then after that, we usually go into some kind of apex formation where we see the failures of the highs to reach the previous climactic high. If we look at the volume signature during the apex is going to start contracting for both supply and demand. And then on the way out, we're going to see that the volume signature locally increased. Here, we just seen this with the price action, the price committing to the downside. So we are expecting that the volume signature is going to pick up here, especially in this area right here. And that's our kind of like typical TP formation structure. Now let's look into this area. So let's imagine that we are trading here. Looking at the monthly, it would be difficult for us to understand, where exactly we should open the position. And then, of course, from the point of opening to the point of where we have the stop loss, we might have a very significant, unit of risk right there. So we need to go to a lower time frame. So let's go from monthly to daily, and let's look at this area right here. And another question before we go there. Isn't volume a criteria to identify phases? And for us, yes, absolutely. And in the advanced Wyckoff course, we would devote a whole series, a whole month to the supply and demand signature, and we would go into the details as to the phase volume signatures. So each phase would have a specific signature and how we would look at those signatures all together. So this is something that, we'll definitely study, studying in April, and then specifically in May, you'll have more information on this. But today we just don't have time for so much material because there is a lot of material right there on volume. Okay, so let's look at the structure at the lower time frame here, going from monthly to the daily. And we're seeing that this was a long-term phase C, a potential long-term phase C at that point. This is how we're thinking about it. We see that even though this reaction is large, relative to this move to the upside, this acts as a change of character. This reaction is more than this one, and we see that the spread is increasing, so we're expecting some kind of consolidation. Here, the consolidation is somewhat upsloping with all of these resistance points right here resting on the same resistance line. I put kind of tentatively here a little bit, this slope, which looks a little bit different, but I think that for those of you who attended the advanced Wyckoff course already, you kind of see where I'm going with this. I want to see this major sign of weakness committing decisively to the downside. Plus, the two support points are kind of like, providing a confirmation that this is a good line as well. And we see that the next attempts to go up all fail, and they act as the last point of supply. And we're still a little bit lost here because for our, intraday trading, this is a little bit too much, for the points of entry. If we're swing traders, we can find a position entry somewhere here in this area, but we want to be more precise. We want to create more sizing. We want to be more accurate in our entries. So let's look into this area. But before we do, and we'll come back to this slide, I just want to show you how great of a trade this was, and actually a couple of students actually implemented this trade. So the price goes down, and it seems that there could be a change of character here relative, to this reaction right here, and there could have been some exits here based on the idea that we might be consolidating, which we did, but consolidation is so weak structurally with the lower lows and the lower highs. This would be another area where we would enter this position again. This would not act necessarily as a change of character relative to this or to this area right here, so we might actually even stay with this. Or if you exit just based on this downswing, also not a bad idea, and then your next entry is going to be somewhere here. But this bar acts as a change of character bar. Remember, we've talked about this, right? A change of character bar that's going to identify the beginning of the change of character rally. Okay, and that's my cue that we're close to the break. This bar right here, this is the spread of this bar. Look at this spread. This is the largest spread so far in this whole move from up here to down here. Look at it. It's just so huge. So that tells us not only that this last swing is done, but most likely this whole move is done, and now we're going to go into the consolidation. And if we would be waiting for some kind of, like, let's say, secondary test, which comes later on, we still stay in this position for quite some time, for almost additional months. We can exit maybe at the better price, and if we're lucky, we can exit maybe on the next day, right here, if we're recognizing this as a change of character. But change of character bars are really crucial, you know, to have a more effective exit. All right, why don't we stop here? And this is what's going to happen next. I'm going to close this session because we want the recording to stop. And then I have emailed you guys the webinar links for all 4 sessions. Let me know if you don't have those links, but you should. I have sent those to you twice or 3 times already. So in the emails, you should have the second webinar link. So I'm going to log off right now. That's going to stop the recording. The recording is going to start converting. We're going to have a 10-minute break. So let's get back at 10:30 our time here, Pacific. And then we're just going to continue from this slide. Let's just have a small break. All right, guys. I'll see you like in 8 minutes or so. Thank you. Bye-bye.